Again, welcome to our Friday forecast on the real estate market. Again, I'm going to bring this up for those of you who have not seen this and want to follow along. I am giving away all the data for free because as a fellow investor, if I was just getting started in real estate, I would want to have access to this before I made any major decisions, frankly, about the real estate market. So here is our link. Again, you can scan this, get access. The link that we're going to be going to, and I will kind of leave this open. I'm just going to do a screen share for everybody so they can see what's going on. Let's just do a full desktop share. But you can scan the right code on the right side to get access to this. This is the most relevant data for the real estate market. Market Pulse. This chart I've made public. So as you're coming on, you can actually go to this, click through the different tabs, see the multiple things that I have here for you to view. And frankly, guys, there's some really important data on here. And you can see that we've got the latest data points up to date on this as well. So let's go ahead and jump in. Again, thanks for being here, guys. And we're going to get started here. So close this up. And let's start with just some basic stuff. So I brought up this outline, and I've done this for my own sake, just to stay on topic. But I want to talk first about something that came in this last month that has given us data on the quarter in terms of real estate. And the headline is that investor purchases have dropped 49% in the first quarter this year. 49%. It's like the largest we've seen in a very long time. And so I want to bring this up so that you guys can see the data. Let me switch over to my browser. There we go. So this is Redfin. I'm not just making this stuff up, guys. Anyone can cross-reference this. You can go to redfin.com. Under their data center. I think this is one of their top articles, and it's not something you're going to see highly publicized on the news, because this is not news that I think our legacy news stations want you to know about. But as it says right here on the top, investor home purchases fell a record 49% year over year in the first quarter. And let me just show you the data on this. Look at the chart, guys. This is dating back clear to 2000. This also includes the 2008 crash. And you can see some of the massive differences. Investors reacted much faster than they did in 2008 when we had the stock market crash and the real estate, the subprime loan real estate crash that happened in 2008. So national year-over-year growth from investor purchases, you can see hit a record low, lower than even 2008 and change. Now, I'm always someone to play both sides. My personality is I'm a debater, ENTP, not like I actually just like to debate. It's actually my personality type. And so I can argue both sides of this, and I think that's valuable to do. Just because it's a 49%, lowest since we've seen since 2000, lower than even 2008. I wouldn't freak out about this to the level that existed during 2008. And here's some of the reasons. This is a year over year number. And because of COVID and the amount of M2, the amount of cash that the Fed's dumped into the market to get the economy pumped back up, obviously you're just not going to see that kind of investor interest compared to when you had that much cash being dumped into the market. And so naturally, you're going to have this kind of reaction to the market. But this is not obviously 3 quarters in a row, last quarter being the worst. There's definitely being a large contraction, and I would say it's a strong reaction to what was already what was already happening pre-COVID. You can actually see pre-COVID, we were starting to dip into this. Markets were starting to settle down and calm down. And then COVID hit, market dropped. We saw like this massive spike. Investors were like, I'm out until I can figure out what's going on. Then we had the spike where tons of cash went into the market. Banks were easy to get money from, but also there was tons of cash to leverage loans from the bank. And then obviously you can see in 2023 Q1 a 49% decline year over year. So this isn't great. I think we're going to see worse numbers coming out into the future, but just keep in mind that this is a reaction from this massive spike. We had the highest spike also since 2000. Aside from this, I want to bring up, by the way, this is a great site. One of the things that I found fascinating about this site is does this one show cap rates? No, but this also shows investor purchases nationally, and it shows the total number, which I think is valuable to know. So you can obviously see that we saw a slight decline during COVID response, massive increase with money supply being jacked up, and then this massive decline first 1-2 quarters of the last report. And then there's a lot of other data in here that I think if you're a real estate investor, you're someone who likes to invest nationally, not just in your own hometown, or you want to compare your hometown to what it might look like in other states, this is just a great resource and tool. One of the things that I thought was fascinating about this site is you can see the different investor purchases year over year change by city or major metropolitan area and state. And you can see that this is an average. This number, this 49%, looks really good compared to some areas. You look at Atlanta, Georgia, 66% pullout. Charlotte, 66% pullout. Columbus, Ohio, 48%. Denver, Colorado, 50%. Jacksonville, 56%. Vegas, 60%. In fact, it's usually Vegas and Phoenix, Arizona, that are the ones West Coast that I follow the most. And sure enough, Phoenix, 64%. So are investors investing in the market right now in real estate? No, they are not. We are seeing the largest decline we've seen since 2000. So what does that mean about housing prices? Well, for you, for me, those of maybe first-time home buyers, millennials that are looking to get into a home, this is really great news. If you bought a home after the pandemic, this is not great news if you need to sell your house. Now, if you had locked in a really great rate early on in the pandemic before they started jacking rates up, you might be in a really great situation. But I want to talk to you about that. We're going to talk about cap rates next, because in order to invest in something, it has to make sense based on the cap rate. So let me just give you an idea what this looks like. Oh, actually, I want to bring this up to a different chart. I took a picture of this. I really like this chart. Yep, here it is. So this is cap rates. So what I've done is I found a chart that compares the cap rate versus your mortgage rate. And I'll explain to you why all this matters. Your cap rate is your internal rate of return for a property, right? So when you've got a cap rate that's low and your mortgage rate is high, it's going to be impossible to make that property work. And I'll actually show you some examples of this. But for those of you who don't know what a cap rate is, this is the capitalization rate, or a better way to say that is this is a way to engage or to indicate the rate of return that's expected by like a real estate investment property. So when you're looking at this chart, you can clearly see you've got your cap rate in green, which is slowly declining since 2015, just getting more competitive, you could even say, and a mortgage rate in orange, which goes up and down. Now, if you look at this, April 2022, so this was over a year ago, we kind of hit this intersection where it became unprofitable. And again, this is nationally, this is not based on certain metropolitan areas or certain cities or certain states. Granted, this chart's going to look radically different depending on where you're buying. But nationally, we kind of hit this crossroads where interest rates or your mortgage rate to go buy a house became more expensive than the cap rate, thus making it impossible to get a profitable return or a return on investment, because you have to, through rents, cover at least your mortgage rate and then all the other little expenses to make it even profitable to do that. And so once this kind of crossed this threshold, you'll start to see in some examples that I'm going to show that this just doesn't work. It doesn't make sense for investors to be buying into some of these areas. Why? Because it's not profitable. And I'll show you a really quick example of this so that it lands for you, why investors are leaving, and they're leaving fast. It just doesn't make sense. If you're someone who's interested in real estate investing, you're buying single family homes, it's really hard in certain areas to find where those cap rates are high enough to justify the mortgage that you're going to have to take out to make this property worth it. And frankly speaking, one of the other things I would bring up around all this is there's kind of this belief that investors or the people going into the market just have all this cash, that there's just tons of cash in the market, and that's how these deals get done. That is not true. Most funds, most investment type opportunities that have to do with REITs, real estate investment properties, or any type of ETF that has like a fund, they're still leveraging bank funds. They'll take 10, 20% of the investor funds, and then they'll leverage it to buy into even more, because then you get a better return for your investor. So all of these, generally speaking, I'm not saying in all cases, generally speaking, you still are getting a loan at the end of the day, even if you're going into a fund or you're making your own investment, generally speaking. So that's why they're falling out so hard. I would say the people who are still in the market that may be buying, maybe getting into stuff, are people who do have just flush cash, and that might be the difference. Let's bring this up really quick. So what I'm going to bring up next is an example, and let me make sure that you guys can see this. I'm going to just give you a basic example, and I love this site. This is ReVenture. You guys can go there yourself. This is obviously not something that I've made up on myself on my own, but ReVenture Consulting put out a chart that kind of shows the Phoenix area. And again, you remember me saying on the West Coast, I like to follow Nevada, specifically Las Vegas, Arizona, specifically Phoenix, in terms of what is going to happen to the other states. Now, Utah, where I'm from, had some very unique things happen, and I'll share that with you towards the end of this in terms of like inflationary, deflationary values. We were kind of one of the hot markets that happened on the West Coast for some reason. A lot of it had to do with the pandemic and people fleeing these like metropolitan cities. But Phoenix, it's already happening. As you guys saw earlier, 64% decrease in investor spending, radical drop. But let me just show you an example. So here, if you're an investor, here's a typical home that you might look for, right? You might go to Redfin, Zillow in this case, Realtor, wherever you go shop for your stuff. And the typical rent on this property or a house like this is going to be about $2,200 for a 3-bedroom, 2-bath, 1,300 square feet, right? And so all your data it's already here. It's already calculated in. Now, this is already a rent cut from 2021. Rents were higher, as you can see here. The rent was listed for $2,350 in 2021, but because the demand and the contraction, in real estate in general, rents are dropping. And because people are finally able to evict people out of their homes, we're seeing these moratoriums come up. California, for like the first time in I think 3 months, these apartment complexes are finally allowed to evict people. It's been years. People have been living in these places for years without having to pay rent. Now it's fine. These moratoriums in certain states and cities are coming up. They're having to drop rents because they just can't get qualified renters. There's kind of this delusionary, I can live for free off the government, but really it's hurting my landlord. Well, anyways, a year ago, 2 years previous to this property was renting for an extra $150. Now they're having to drop the price. And let's just say they have to give this up because it just doesn't make sense, or maybe they were using it for their own personal use or whatever, right? Or maybe it was a second home that they bought, because they moved into the second. They're, we'll make some money renting our last home. Well, now it's not making money, right? So the purchase price of this house was $440,000. Monthly rent was $2,200. So the annual rent was $26,000. And let's just calculate in some vacancy, which is what you want to do. Gross income would be around 24,000. Then you have all your taxes, maintenance, insurance, utilities. This is what you do on any property. Total expenses are 7,000. Net income would be 17,000, which is a 4% cap rate. Makes sense if I bought the house back in 2021, right? But if I were to buy that house today, if we had any contraction in the market that made people start buying their homes, like one, we're going to talk about this, unemployment goes up. And by the way, and I don't have time for this today, but if you were to look at the national debt, like credit card debt, income, or total household debt in the US today, we are at record highs. People are living month to month, and I would say our saving grace, the one thing that's holding this whole thing together still, is unemployment. And unemployment is at record low numbers. We are just rocking it with jobs right now, even with the hype and the layoffs and a lot of this talk about the labor market contracting, which I think it actually is. It's our saving grace, because the moment people can't start paying for their mortgage, then they have to default or give the home back or try to sell. And you know what? No investor in today's market is going to buy this house. And let me show you why. So if you go through this, we talked about the cap rate, right? This is a really important number, the chart that showed the intersecting cap rate to mortgage rate. Well, what's been happening to mortgage rates? Well, because of inflation, the feds have been constantly piping in, right? They've been saying, we've got to make a difference here. We've got to make a change in how we're doing rates in order to get inflation to come down. So you've been seeing 3/4 point rises, half a point, quarter point, and this might be the first month where they actually pause, but there are more rate hikes coming. It's factored in. The biggest bankers and financial advisors in the country are saying we're pricing in probably another 2/4 point raises minimum, but they're pausing right now because they don't want the banks to fail. But here's what's going on. So here's your purchase price, right? You've got the net income, cap rate of 4%, purchase price today. Let's just say somehow they sold it for the same price. They got out, they finally said, you know what, I don't need to make any money on this which, by the way, a lot of property owners aren't doing. They're trying to get more. They think this is pre-COVID and these houses are just going to fly off the shelf because they're just not used to today's 2023's market. But let's just say that they got it for 440,000. Your profit loss would actually be negative $6,600 on this property. Why? Because of the mortgage rate. Your monthly payment just went up to $2,024, where your previous amount was much, much less than that. So in today's world, if you were to pencil this property out and go, oh, should I buy this house as an investment property? You'd look at this and you'd be like, no freaking way. There's no rhyme or reason why I would ever get into a house like this with this rent amount with a mortgage at 6.9%. I would lose money. Even if it was break even, investors wouldn't be interested. And guys, that is why there's a 64% drop in investor interest, particularly in the Phoenix markets, because it's awful. And this is what happened in the last crash. Vegas and Phoenix led the crash. They were about 6 to 8 months ahead of the rest of the country. So this is something that's going to continue to happen. All right, so next up, let's go into this. I've got temperature, unemployment rate, spread. Okay, so what I want to talk about next is this next leveraging piece. So we talked about like what's going to be the straw that breaks the camel's back, right? And if you look at the data closely, I would say the thing that's holding this whole thing together, the one thing that has not contracted is unemployment. And you can see this data is directly from the Fed. Like this is, you guys can get the St. Louis Fed data. You can go to the site. You can look through this on your own. You can manipulate the charts, but you can see here we've had record low unemployment. Like, this is great for people. Like, people who want jobs can go out and get jobs. There's no excuse. By the way, if you're listening to this, you're young and you're like, oh, it's so hard to get a job. You have no idea what it looks like for things to be hard to get a job. Meaning, this is the best environment. If you think it can get any better, it's time to wake up, because this is probably the easiest and best environment to go out and find a job. The feds are targeting a 6% unemployment rate. 6%. If you look at this, I don't even know if we've seen 6%. Oh, yeah, we have. That's like a 10-year ago price, or a 10-year ago number, percentage. So we've got to be back to 10 years ago data in terms of unemployment to get things rolled back up. If you look at a max, when we were in 2008, guys, and we had the housing market crash, we had unemployment almost up to 10%, almost 10%. That's a tenth of the population wanting to go out and get a job just couldn't. It wasn't possible for them to find a job. And then as we did a lot of QE, started lowering rates, you can see that the unemployment came down. Well, now we're hiking rates, unemployment not going back up like it did before. And it might be the only thing that's holding things together is what we call M2. We're going to talk about that in a minute. But we had all this cash piled into the market. And inside of the market, because of all this cash holdings, companies had extra runway to keep their employees. And so is that going to last forever? Absolutely not. I'm going to go through that data here after this, but let's dive back into the real estate, because I don't want to end on this note. So I think I've proven my point. Investors are out of the market. So now the question is if you're a first-time home buyer, or if you're someone that's just looking to buy a vacation home, or you're looking for like something that's for yourself, is now the right time? I would say based on the contraction in the market, it's more of a hold. But before we get into this, I have some more data that I think you'd be interested in around the ABS market for investors, just to give you, again, a sign or a signal of how much smart people who invest in properties and foresee the value going up and the ability to get a good rate of return on these properties going up, how they are reacting to this. So this is an ABS market review. So this is basically all of the properties, all the investment property or investment dollars that are going into asset-backed securities, typically some form of real estate. I think this also includes commercial. But you can see that the amount of interest that's going into 2023 is just nominal compared to 2018. I mean, it's just tiny. Now, granted, this isn't the end of 2023. We're about halfway through, right? We're 6 months, getting into the end of 6 months into the year. But double this. Look how small this candle is going to be if we double it, right? We're at 0.6 billion. We're not, just round it up, call it a billion. Say we get to 2 billion. 2019, we were at almost double that. So we do not have the interest in the market, which is great for supply, bad for demand. What does it mean? It means that the housing market is cooling. It's going to get better for buyers, worse for sellers, because there just isn't the demand for investors like there was 1, 2, 3, even 4 or 5 years ago, right? So we're heading into great territory if you're looking to buy a home in the near future. One other thing I want to bring up around this. Oh yeah, let's do this. I want to talk about M2 supply. So this was that data that I was sharing, and this is what the feds they were saying they were going to do this about a year ago. They said that they were going to start shredding cash and that we should see this decline in M2 about a year ago, and we didn't. We continued to see, if I just do a 5-year on this, we continued to see this incline in M2 supply, which is the money supply in the market. Now, this number is contributed by multiple things, but let me share how this contracts and increases from a monetary standpoint. The way that this is leveraged the most is actually money supply through banks, meaning one of the ways that you kill money supply, you shred dollars. We always see this thing with Jerome Powell, and he's like shredding the cash and the money's spilling out. He's got this crazy face and he's like shredding money. It's like, no, that's not actually how the feds don't actually like take money back and then shred it. The way they actually have money supply contract is they increase interest rates, because then from a bank standpoint, a bank's going to have a much harder time lending, and they're going to be looking at deals a lot closer. And so the money supply that goes out through lending practices, through our existing banking structure, it just doesn't happen. And we've already seen that banks are not giving the loans that they used to, because the money, frankly, is just more expensive. And as the money gets more expensive, people don't want to invest in these real estate deals because they just don't make sense. But check this out, guys. So yes, is money supply dropping? Yes. Is this going to be good for inflation? Yes. Should we start to see the prices of goods, services, supplies, housing market drop? Yes. This is a great indication of that. However, let me show you this. So if you go to edit graph, I want to show you year over year change. And this is scary numbers. Like this, the data we keep seeing, I think I've shown you guys 4 examples of record numbers that have happened in the last 30 days, like all-time records. If you look at even a 10-year on this, so this is money supply, but what I did is a year over year change. So this is year over year, right? Did I do year over year on this? Let me make sure. Change from a year ago. Yeah, so this is change from a year ago. Now, granted, we had a ton of cash go into the market a year ago, and so the contraction on this is going to be hyperinflated. It's going to look a lot bigger, but still, we are hitting record numbers, guys. For the first time in a very, very, very long time, we are going into the negative on year over year. And it's not some small number. It's enormous. In fact, I think I can pull up a percentage. Let's do percentage change year over year. Look at this number, percentage change year over year. We're at almost 5% negative. Guys, this is 10 years. We've never been in the negative over 10 years. Let's go max. Never. Since 1950, 1960, as far back in the chart as I can go, we have never had a negative year over year change in M2 supply. So what does this mean? Well, M2 supply is this indicator for how inflation and deflation is going. Well, we had a ton of inflation. Everyone already knows this. Deflation allows things to settle back in, for things to stabilize, right? We've got to get inflation back down to that 2% that the Fed's like. It's still lingering in that like 4 to 6% range, as a lot of economists are predicting. So we've got to rein it back in. We haven't done enough. And so to show this already in the negative, and the Feds have more work to do, it's like, we are heading into radically unknown territory, meaning like next month, we might be doing even more records. I might be showing up next month and showing you guys data that's like breaking every record that happened this month. What we're having to do to fix what's going on with our money spending problem in this country is insane. It's unsustainable. Everyone knows this, but our political process allows it. And we're going to have a new, some radical reform in how Congress allows us to increase the debt ceiling like we experienced last week, increases the amount of money supply that we're pumping into the market, and frankly, how we reacted to COVID was highly overreactive, and the amount of cash that we pumped in was completely unnecessary, in my personal opinion. So we're dealing with some things that it's going to shake our country. And because we're the reserve currency of the world, it's going to shake the world. My guess is we're heading into recession territory, and I don't think it's avoidable. We need a recession, as weird as that sounds. We need deflation. We need house prices to drop. We need price of goods to drop. Otherwise, moving forward is going to be unsustainable, and we might go into some hyperinflation numbers with the US dollar, which would be awful for everyone. No one wins at that point. All right, so what's next? Lots of data, guys. Oh, I love this. You guys are going to love this. So if you're looking to invest or buy, and you're trying to get a sense of like, is my head screwed on straight? Because I can't tell you how much I talk to real estate investors. I talk to real estate agents. Gosh, there's so many uneducated real estate agents out there. I talk to commercial real estate investors. I talk to loan officers, broker dealers. All of these guys generally have a sense of like what's going on, but it's actually shocking how much we live in a bubble. And what I mean by that is like, you know, your market, you know, your city, you might have gotten good enough to where you have a sense of what's going on in the state, but to get to a national level and to be able to compare what's going on in your metropolitan area to like what's going on the other side of the country, I would say most people, even really good investors, don't do and have that type of data. And I'm going to show you guys a resource that I just love if you're looking to buy soon, or maybe you're looking to relocate. This tool is incredible. And for those of you who are investors, there are still markets where that cap rate's high enough to make up for the mortgage rates in certain areas. Like there's 5%, 6% cap rates still in certain markets. But it's like, where would I look? I'm going to show you. This is a really great site. So we're going to go. Let me actually bring this up. Oh, I can't do that. So back to this reventure site that we were on just a minute ago. And then I'm going to bring you guys into my data that actually shows like what happened in the last month, because that's why you guys are all here. I'm going to show you this site as another resource. I just love giving you guys tons of resources when you're interested in the real estate market. And this by far is probably one of the most dynamic, interesting, intriguing, but playful charts that I think will help you make better educated decisions in your real estate investments. Or if you're buying for the first time or relocating, man, this is like a relocation map haven. I love it. There are lots of data points, so you get kind of used to some of the things that you can play with. I'm going to set the data point to cap rate. You can actually type them in up here also, that helps. But let's just say I'm looking for a cap rate that we were talking about, and I want to get my cap rate up. Like I want to have a higher cap rate. So I'm going to add on this data filter a cap rate filter. So we're going to add a filter for a cap rate. And so here's my cap rate filter. And I obviously, based on the chart that we saw, I want this thing to be at least over 5%, or I'm not even looking. We might even go like 5.5%, because it's like with today's mortgage rates, you're not going to make anything make sense. Like it's just not going to happen. So I've just adjusted this to a 5.4, 5.5% cap rate. And you can see immediately, it gives me the geological references and the different metropolitan areas and states where that exists, blue being low, red being high. And so it's really interesting to see. You're seeing things in like New Mexico where the cap rate, look at it, a cap rate of 9.6%. And if this is too hard to absorb, you can actually go into a table view and you can sort it by highest to lowest. Look at this, guys. Ohio, 12%. Where is this? Whoa, is this LA? Yep, LA. Oh, this makes sense. There's stuff dropping out from there. Alabama, Oklahoma, LA again, little micro area. So yeah, really interesting, guys. All just like we said before, you can be in one area of your state and the cap rate's just awful. One area where it's really good. It's just going to depend on which areas are hot, which areas got overbought. A lot of it can deal with like what's the demand, population growth, which there's a lot of fun tools on here also that you can look at all that. But anyways, so this is fascinating. You can also play with, so just getting rid of that. If you're just looking to buy and you're like, I want to see like which areas are the most undervalued. You can do that also. So it's like, you can say, well, I really want to look at like what states are really undervalued. And you can see like low end undervalued to high end undervalued. And then you can look at stuff that's overvalued, which is going to push us into like negatives. Let's just go this way. And then it slowly diminishes. something that I thought was interesting is if you look at the Arizona area, did I open this up enough to see that? But if you go into like the Arizona area, it's interesting how your your undervalued areas, like good places to buy, are more in red. And it's interesting how the West Coast really has taken a hit in terms of things being overvalued. Like there's this kind of overvalue consensus, and Utah, being my home state, is one of them. You just never would have saw this, but Idaho, Utah, highly overvalued, almost comparable to some of the major metropolitan cities in California. And it's like, what? How did that happen? Well, everyone left. During COVID, people left all these major cities and fled to states like Utah and Idaho because of the lack of shutdowns. They could raise their family, their kids could still go to school. So they left their states, came into these states because of that. Property values, because there just wasn't enough homes for sale, property values went nuts. And I'll also say they came from these states where houses were twice as expensive. So they saw something that was half the size, right? This like huge home, but it was half the cost. And to them, they thought they were getting a deal, where for Utah's market, it was like, no, that makes no sense. So anyways, this is a great resource. I know I'm running out of time here, but great resource if you're shopping or investing nationally, or if you're about to make an investment, you can quickly pull this up and go, whoa, am I in an area that even makes sense? Should I be buying in this area or not right now? So this is a great tool. That way you can dial it in by state also. You can compare your state to other states, obviously do table views. Yeah, great resource. Reventure app. I think I've done a good job promoting these. These guys need to send me a free baseball cap, I think. All right, so that takes care of the last piece of data. Now we're going to go into our stuff, which is the important stuff. And that's our charts that I'm giving you access to, so that even with all this news, all this data that you probably caught wind of a little late, you weren't able to follow it as quickly. We now have new data for last month, both for Utah and the US, and I want to show you guys that. So if you go to that chart that I sent, and I'll make sure to put the link in the bio or the chat or the, whatever platform it is, in the details, I'll make sure that this link is in there. I've made this public and free. Here it is, guys. Median. So with everything I've said, we've got some data that seems to contradict what's actually being put out. So with investors dropping out, everything else happening, mean prices the last 1, 2, 3, 4, 5 months have been back in the climb. They've been rising. So here's how I'm going to caveat this. Are they as high as they were? No. You can see that we are actually just surfacing below the peak of last year, which is not typical. Typical declines go up, slow down, up, slow down, up, slow down, right? And COVID kind of messed with this a little bit, but that's typically how it happens. We had this climb in 2022. Everyone was getting in while rates were still low, and then rates just got too high. Cap rates didn't make sense, so the decline started to happen. Also, people just couldn't afford it. They had to buy smaller homes for less price because the rates going up. And then spring hit and prices started going back up. Now, here's the problem with this. Typically, we see higher highs every year. Higher high from the previous year, higher high from the previous year, higher high from the previous year, higher high, higher high. This may be the first year since 2018. Actually, this data goes way back. It may be the first time since 2010 that we've had a year that does not spike above the previous year. So what does that mean? Well, for those of you who day trade or look at charts all day, that means we may have hit the top. It means that we are testing the ceiling. There's massive resistance at this price level. Numbers just don't work. And with interest rates continuing to come, I would predict that this may go a little higher. This is 5, right? And this one was actually 6. So we've got maybe one more month of incline for the country, and then we're going to have the same drop off. And I would guess with everything going on, if unemployment goes up more, that this will drop to lower lows below last year's low. And then we'll start to see the reversal in the chart. You'll start to see these humps each year going into the opposite direction, unless it just crashes. And we see this massive fallout and then a rebound back up like we saw in 2008. So there's median list price. Let me show you some other data it's promising. Average listing price is at an all-time high. So the average listing price is hitting a record. Now that's listing, that's not for sale. It doesn't mean housing price that actually sold. And that doesn't have to do with square feet either. We're seeing people are getting less for more these days, meaning they're getting less square feet for less price. In fact, that's in our median listing price per square foot. You can see that that is actually lower than the peak of last year. People are getting less for the price. So they're spending more and getting less. That's inflation. So these charts, what we're actually possibly seeing with average listing price is somewhat inflationary. And so as inflation starts to come off, unemployment goes up, we should start to see the average listing price reflect that also, especially with M2. Now that we're shredding money, we should see that also with M2 coming down. But having said that, price increase amount, we did see price increases through the spring. Not what I would want to see in terms of leveling off to have a hot market. This is definitely starting to turn into a buyer's market from a seller's market, where we're used to seeing 2018 massive climbs in the summer, where this is kind of showing we're not getting the price bumps through the spring to summer that we're used to. So I showed you guys, I didn't show you price reduction. Price reduction count has come up a little, but that's not good news. It came down through the spring, which makes sense. You start to see the prices go up, price reductions. If prices are going up, why would, obviously you're not going to have that reduction. So this drop makes sense with that. Then it went flat. And this is the first month nationally in 1, 2, 3, 4 months, guys, that we've seen it tick back up. So we're already seeing house prices drop. And you saw why. Because to an investor, the current price to make something work, to have it be an investment property, just makes no sense. It's not possible. Let's talk about the pending ratio. Pending ratios, we like to see above 1. Obviously, historically, we don't see that, which makes it more of a buyer's market. But if it's not at a 1 ratio, then that means we've got more houses hitting the market than are being sold. Now, this is a nice curve that we do like to see improving the housing market, but you can see it's a curve. This is not a nice linear line. This is a curved line, which shows that probably next month we're going to see it go sideways, maybe even somewhat to a decline. But my guess would be July, you're going to see this pretty sideways in terms of the pending ratio. And then as winter comes, it's very common to not see homes listed. But if there's a scare in the market or unemployment ticks up, this pending ratio is going to look ugly, meaning that there's going to be more homes listed than being sold, caused by the pressure of unemployment, which is kind of that variable that we're all waiting for. New listing count, you can see, went up. So new listings are coming up. This whole supply thing that, there were people like Grant Cardone, I remember saying years ago, like, if you don't buy, there's not going to be any homes in the next couple years, blah, blah, blah. And it's like, yeah, there's cycles in markets, Grant. Like, that's not how this works. We're seeing that here. House supplies have almost doubled from the low. And it's like, where did these people go? Where did they live? Well, I'll give you one example I haven't mentioned yet, where I actually think the housing market's going to contract quite a bit. If you don't think that those investment properties for rentals made sense, look at VRBOs and Airbnbs. It makes no sense. There is not a property to buy for a vacation rental right now with the existing rate and the appetite to go vacation that makes sense anywhere. I would say actually even today, a lot of the homes that you're going to see first come off the market are going to be vacation rentals that just can't make sense anymore. And what I mean by that is if you have, let me just bring this back. If you have a vacation rental property, it is very likely that your debt to service that, plus all of your expenses annual, could not be maintained by a regular renter. They are typically in geographical locations where the price of the home is already inflated because it's a high vacation type area where it's kind of propped up the real estate prices. And why? Because you could buy a property and rent it for 4 times the amount on a day-to-day basis or a weekly basis. Some people are even getting a week's worth of rent compared to a home next door that's a whole month worth of rent. So you take that idea and it's like, wow, that makes total sense for an investor, total sense to like have a pitch deck with like all these investment properties where you're making this type of money. But once the market contracts, and let's say you go to 50% occupancy rate and your mortgage is, $10,000 on one of these vacation homes, and you're only making $8,000 in vacation rent, you can't go to a regular renter and say, hey, would you rent this for $10,000? No one's going to do that. The house next door is renting for $6,000, maybe $5,000. And so there's a massive problem, I think, about to implode on the vacation rental properties, because as soon as unemployment ticks up, guess what happens? That demand for those homes radically drops. The rent properties for those have to radically drop to get, the appetite. And frankly, there are more vacation rental homes now than there ever has been in the history of this country. And somehow they're staying full. And I think a lot of it has to do with unemployment. But you take the national debt, unemployment going up, people aren't going to vacation anymore, guys. It's going to be the first place where that contracts. All right, so back to this. So back into this chart, I'm going to go through a couple more of these that I like. Active listing count is ticking up also. That's great news if you are a buyer. This is a little premature. Look at the chart on this. So this is 5-1. We're seeing this tick up. I just want to show you the difference. 5-1. Let me show you 5-1 here. 5-1 here happened a lot faster last year, and that was because of the massive rate hikes. But if you go back into like a normal year, it's like midway. So this is like midway into the hikes. And so that if you're a seller or hoping that the price is maintained, this is actually good data that's showing that the house prices likely will maintain, because this is what a normal active listing count, we typically have a whole nother, halfway to go. Let's see where it is here. Yep, about halfway in this climb also. Where if this is halfway, that means we're only going up into here. And anyone who understands supply and demand, the more supply you have, the more the price has to drop. The less supply you have, the more you can ask for, right? The higher the price is going to go up, because there's high demand below supply. So, there's just no inventory. So inventory really does affect market price. And again, this was the low from last year. If this is the low from this year, I would anticipate, just looking at the pattern, this was probably the all-time low. Easy to see, low, right? And we're likely to see these go up if there's any other scare, if there's any other thing that happens that creates a scare in the market, which would bring us back into previous levels of supply in the housing market. TLC is the total listing count, similar data. We're seeing similar retracements. Again, the low here. I would expect or anticipate, if the pattern continues, that we're going to have new highs, meaning we're going to get back into this territory of having a higher number of homes, which is good for the buyer, bad for the seller. Pending listing counts. This is good data. I mean, this is good data for the real estate market. Very typical, by the way. This is the month of 5. If you go back here, 5 is kind of the peaking month. And so we're kind of back into the peak of pending listings. And it's pretty high. It's higher than post-COVID numbers, but it's kind of getting back into that. You can definitely say that anything that was going on COVID number-wise, in terms of selling your home or buying your home, those days are over. You don't need to worry about it if you're a buyer. And if you're selling, you're just not going to get the prices, and you're not going to get your house sold in a week and not have anyone look at it. Like, those days are definitely over. Median square feet. The median square foot of the house selling is going up also, which is really interesting. This data tells me that the buyer is moving into a larger home now. pre the COVID era. What was interesting is the homes that were selling the most were actually lower square foot homes during COVID. So these like really small homes were getting bought up because they looked cheap. The rents made a lot of sense. And so you could get that cap rate high enough to overcome the mortgage rate that you would have. But after that, I think what's happened is a transition from the investors buying, like we talked about, to just traditional buyers. And so now we're starting to see an uptick in people just buying larger homes. Frankly speaking, the homes that were inflated the most were those really expensive homes. And those prices have significantly dropped. I've even seen you to 100, 150,000 price drops in the last 6 to 8 months. And so people are moving into those homes, which is bringing the median square foot price up. This is valuable data also, median days on market. This is how long a house sits on the market. And you can see that it usually drops to all-time lows during the summer because they list during the spring, people get really hot. And then summer kind of hits the peak, inventory starts to stack up. People aren't as interested in moving during the fall and winter. And so it will take longer for people to get out of their houses. And you can see here, here's 5-1 here, 5-1's a low here, 6-1, 5-1's a low here. So we're kind of at the base here. I would anticipate if you're looking to buy, if you're looking to make an investment and you don't have to do it immediately, you might wait till next month's data to make a decision, because next month is really going to be indicative of like, how do things look going forward? Are we right? Are we actually predicting this right, that there's going to be lower prices, lower lows? And frankly, guys, if that's the case, it might be a good time to wait. You might have to wait 6 months to a year to find this bottom. But if interest rates aren't going to keep climbing, I mean, there might be a quarter, half a point rate increase in interest rates. It may just be best to sit. It may be best just to wait this out and get a better home price, not much of an increase in the rate, lock that low price in. And then next time they do QE, guys, you could refinance and get a lower rate and a lower payment. Here's all the data that comes in. Here's my credits. All my data comes in from realtor.com. I have to give them credit for this, guys. We are running out of time, but I'm glad that you guys are on. So having said that, let me just end this. Go. I want to end just on one note, and that is obviously everything I've shown you guys is my own research, my own personal data that I've gone through, made my own conclusions. So if you're going to make an investment on your own, or you're going to go out and make some type of decision based on data that you got from my channel, make sure you do your own research. Make sure you speak to a licensed professional. This is only for educational purposes only. And my goal is to give you the best data, the most relevant data, so that you know what to do with it going forward. And you can see, like, there's some massive opportunities coming, I believe, based on what we're seeing. So stay tuned for next month. We will be doing this same time, same place, not the first Friday, but the second Friday of every month. And next month, just as a plug, I have a personal friend and real estate guru and expert who's going to be joining us on the podcast. His name is Keaton Schultz. We do some real estate stuff together out in Wisconsin, and we're going to bring him on, get kind of his take next month. And I'm just really excited to have him on as a guest. He'll be joining me live from his home state, and we'll be going through the same data and kind of getting a sense from him what's going on his side of the world. Because as you guys saw in the charts, the West Coast and the East Coast are just, they're like two different universes right now when it comes to real estate investing. So I'm looking forward to having him on the show. Again, guys, Matthew Pohl, Market Pulse Podcast. Great to have you on today. And we'll see you same time, same place next week. Thanks.